Number 26 of the House of Commons Standing Committee on Finance. Today's meeting is taking place in a hybrid format because we have a lot of people joining us online. I just want to reiterate what the process and the procedures for a hybrid format. I would like to remind participants of the following points. Before speaking, please wait until I recognize you. For those participating by video conference, click on the microphone icon to activate your mic, and please mute yourself when you are not speaking. En ce qui concerne l'interprétation,
for those who are on Zoom, when it comes to interpretation, you have a choice at the bottom of your screen. You will be able to select the channel for interpretation, floor English or French. Those in the room can use the earpiece and the right channel.
Zoom, please raise your hand if you wish to speak. The committee clerks and I will do the best we can to maintain consolidated speaking order. A reminder that all comments should be addressed through the chair. So pursuant to the order of reference of Wednesday, December 10th, 2025, and the motion adopted on Wednesday, December 10th, 2025, the committee shall resume consideration of Bill C-15, an act to implement certain provisions of the budget tabled in Parliament on November 4th, 2025. I would like to now take a moment to welcome and introduce our witnesses that are joining us today. We have Carol Wilding, the Chief Executive Officer from the Chartered Professional Accountants of Ontario. On a Hubert Rioux, le directeur économique.
Hubert Rioux, Economic Director, and Mathieu Lavigne, Vice President of Public and Economic Affairs at the Federation of Quebec Chambers of Commerce.
Executive Director from Fintechs Canada, as well as Jessica Oliver, the Head of Government and Regulatory Relations from Wealthsimple. You will have 5 minutes for your opening remarks, and we will begin with Ms. Wilding, please.
Thank you, Madam Chair. Good morning, everyone, and thank you, honourable members of the committee, for inviting me to speak today. As President and CEO of the Chartered Professional Accountants of Ontario, I'm here to bring the perspectives of more than 105,000 CPAs in Ontario, which is almost half of all CPAs in the country, to this important discussion on Budget 2025 Bill C-15 and the future of the Canadian economy. At Davos, Prime Minister Carney laid out the stakes. Canada's economy is facing a rupture, not a transition. We recognize what is happening, and we're determined to act accordingly. Given the foundational role that CPAs play in Canada's capital markets and the economy, the profession is ready and willing to step up and help drive the economic growth that Canada needs now more than ever. As tax practitioners and advisors, CPAs understand the important role that tax policy plays in empowering growth or constraining it, which is why we were pleased to see Bill C-15 propose some important measures to address long-standing issues with Canada's tax system. For instance, CPA Ontario has advocated for the restoration of the accelerated investment incentive through the productivity super deduction. This reinstatement will help to boost investment, allow faster depreciation of capital assets. It will enable firms to recover capital costs more quickly, enhance cash flow, and encourage reinvestment into Canadian businesses and Canadian workers. But capital is always looking for stability. In times of upheaval, certainty would be a competitive advantage for Canada, which is why the accelerated investment incentive and other provisions in the productivity super deduction would be even more impactful if they were made permanent. Investment is key to Canada's future, but that investment needs to go to the sectors where it will yield the greatest benefit. Our natural resources are still essential for building Canada's future, but we all know that the global economy has changed. Intangible assets, such as intellectual property, artificial intelligence, and data, now play a critical role in economic prosperity and national sovereignty. Our tax system must evolve to reflect this reality. The simplification and expansion of the SR&ED tax credit in Bill C-15 was a welcome change, and one that Canada's innovators and entrepreneurs have long advocated for. But this is not a moment that can be met with incrementalism. Canada must be bold, ambitious, and willing to act. We must recognize that after decades of a piecemeal approach to tax policy, we have a system that is unwieldy and complex, and that complexity is a barrier to investment and growth. As tax specialists, CPAs can see the consequences firsthand as capital is diverted away from where it can be put to the best use. Bill C-15 makes some efforts to address this, including through the proposed elimination of some inefficient tax expenditures. But we are still a long way off from a necessary and, frankly, overdue broad review of Canada's tax system. A robust expert review that could be used as a blueprint for a tax system that drives growth, competitiveness, and productivity for Canada. Reforming our tax system will help Canada attract the investment, entrepreneurship, and talent that will grow our economy, create jobs, and raise the standard of living for all Canadians. Echoing Prime Minister Carney, nostalgia is not a strategy. To quote, "Now is the time to execute fairly and fast." Thank you, and I look forward to answering any questions that you may have.
Great. Thank you so much, Ms. Wilding. On va continuer maintenant avec la...
We'll continue with the Quebec Federation of Chambers of Commerce. 5 minutes. Good morning, and thank you to the Standing Committee on Finance of the House of Commons for inviting us to speak on C-15, the Budget Implementation Act. The FCCQ encompasses over 1,000 businesses, 120 chambers of commerce. We represent over 40,000 businesses in Quebec. We were in Ottawa to present the budget. We also present pre-budget remarks to show the consensus of businesses on policy. For the bill we're looking at today, this budget is a transformative budget. It is focused on investment and defense. I reiterate how important it is for Canada to establish an industrial defense strategy because Quebec is in a very good position to receive a significant part of defense investment. We would wish to see the enhancement and incentives of research and development. It is finally in place. That's good news. We need to continue supporting private investment in innovation. The super deduction for productivity is also a good measure in the same vein. Eliminating the luxury tax on aircraft is something that was very well received by the Quebec aerospace industry. It's also a foundation to build strong communities, $51 billion over 10 years to fund local infrastructure. We hope to see these projects deployed quickly. Quebec regions need to have their fair share of the fund. We are extremely supportive of increasing capital gains, the capital gains exemption to 1.25 million. We expect over 50,000 business transfers by 2030. So it's very important to have measures like these. However, we're disappointed to see that the Canadian Entrepreneur Incentive in the 2024-25 budget was cancelled. That would have reduced the capital gains inclusion. We are also very glad to see the Paperwork Reduction Act amendments that allow ministers to grant temporary regulatory exemptions. This is logical and should be made systematic as long as it's transparent and has well-defined criteria. What we would like to see and do not see in C-15 or the budget are the following points. General corporate taxation, there's no relief planned. The U.S.'s One Big Beautiful Bill Act is a turning point for our tax competitiveness and our ability to attract investment. We requested an increase in the small business deduction that would have helped all SMEs across Canada. In R&D and innovation, there's still insufficient tax incentives to commercialize patented innovations. We have a deduction of that kind in Quebec, the deduction for commercialization of innovations. Accelerated investment incentives should be permanent rather than phased out after 2030. The U.S. has done that in its bill. And we can't talk to federal members of parliament without talking about temporary foreign workers. We are asking for a complete moratorium. People are abandoning projects and investments because they cannot find workers. Regarding public procurement, reciprocal procurement and Buy Canada policies should apply to strategic tenders that were already underway before they were implemented, like via rail. In exports, the goal is ambitious to double exports outside the U.S. by 2035, but the support measures announced are not sufficient to achieve this. Part of the revenue generated from the sale of products and services in new markets should be tax exempt. There should be a tax credit applied to marketing expenses incurred in developing new markets. Financial assistance for businesses and sectors affected by U.S. tariffs have overly restrictive criteria. Funds are difficult to access. In the telecom sector, hundreds of companies are at risk. Several CRTC decisions could have the effect of inhibiting regional investment. So that more or less covers what we discussed in our brief, and we'll have an opportunity to elaborate in answering questions.
With Ms. Vega from Fintechs Canada for 5 minutes, please.
Thank you, Madam Chair. Good morning. My name is Adriana Vega, and I'm Executive Director of Fintechs Canada. Fintechs Canada is the leading voice for Canada's financial technology sector. Collectively, our more than 50 members serve millions of Canadians across the country every day. Thank you for the invitation to appear today to discuss Bill C-15. If passed and implemented, the financial sector reforms included in this budget bill will help make life more affordable for Canadians and our economy more productive. As we know, our financial sector is highly concentrated, and over time, this has had real impacts on Canadians' ability to hold agency over their money. It has also limited access to capital for both individuals and, critically, for our small businesses. Canada has not kept up with the rest of the world in boosting competition in our financial sector, limiting Canadians' access to broader choice and bespoke and affordable offerings. The reforms included in Bill C-15, concretely those introducing Canada's open banking regime, are hugely welcome and long overdue. When enforced, the Consumer-Driven Banking Act will make the financial sector work better and harder for Canadians. By way of example, research by the Competition Bureau estimates that in the insurance sector alone, a data portability framework could save Canadians between $1 and $3.8 billion annually. Also in the BIA is the Stablecoin Act. This is an ambitious piece of legislation that responds to industry calls for a federal framework, and one that we believe will support Canada's sovereignty in the future of finance. However, the road ahead is still long. Regulation still needs to be developed, and we now need to focus on striking the right balance that provides clarity, certainty, and safety, and that preserves the pro-competition spirit of the law. Canada has a unique opportunity to leverage consumer-driven banking and transformative technologies like stablecoins to provide a long overdue boost to our economy, and delaying is not an option. Thank you for the invitation, and I look forward to your questions. Thanks.
Great, thank you, Ms. Vega. And I will now turn to Ms. Oliver for 5 minutes from Wealthsimple.
Merci, Madame la Présidente. Et
Thank you, Madam Chair, and thank you, committee members, for inviting me to testify this morning. It is a pleasure to be with you.
Wealthsimple is now one of Canada's most trusted financial institutions. We serve more than 3 million clients from coast to coast to coast, holding over $100 billion in assets on their behalf. We've pioneered products that have driven down the cost of financial services, from commission-free stock and ETF trading to no-fee interest-bearing checking accounts. In 2025, we saved our clients an estimated $1.3 billion in fees and paid out more than $200 million in interest in everyday checking accounts. The Budget Implementation Act your committee is considering enacts key legislative changes we regard as critical to building a more competitive, dynamic, and consumer-centered financial sector, including the completion of the open banking framework, which, when combined with the launch of real-time payment settlement, will make managing money faster, safer, and cheaper for Canadians, and the creation of legislation regulating stablecoins, which will enable Canadian companies to bring Canadian dollar stablecoins to market, offer settlement efficiencies, and bolster our monetary sovereignty. We're pleased to see Parliament thoroughly considering the legislation and hope to see the process conclude promptly. The most immediately impactful change for Canadian consumers of financial products in Budget 2025, though, is the government's promise to introduce measures this spring to prohibit exit fees on investment and registered accounts. These fees have skyrocketed in the past decade. In February 2016, a CBC consumer report found that the last of the big banks had introduced an exit fee on TFSAs, moving from $0 to $75. Less than a decade later, transfer fees are a near ubiquitous $150 per account. At the same time, the number of accounts Canadians hold has increased dramatically thanks to the wonderful popularity of the TFSA and the FHSA. While Canadians have some of the lowest rates of checking account switching, competition among investment platforms is healthy, and this is a good thing. It means consumers are engaged and making decisions, and we continue to see record inbound and outbound transfers because consumers are shopping around. But last year, clients transferring accounts to Wealthsimple were charged more than $60 million in exit fees. In January 2026, $10 million. These flat fees fall hardest on younger Canadians and those with smaller balances, the very people these accounts are designed to protect. It costs Wealthsimple about $2 to process an outbound transfer, and we don't charge a fee. I want to share two real examples of what this looks like for regular Canadians. A 25-year-old man from Calgary transferred 4 accounts, a TFSA, RRSP, FHSA, and a non-registered account from a major bank. All 4 transfers were processed electronically in under a week. The administrative cost to the bank was a few dollars. He was charged $600. These fees bear no relationship with the actual cost of processing a transfer. Meanwhile, a 71-year-old retired bank executive in Northern Ontario transferred her savings, a TFSA, RRSP, and a LIRA. $2 million in investments were liquidated and cash was withdrawn from her account. The funds didn't arrive at Wealthsimple for 26 business days, costing her more than $10,000 in foregone interest, exposing her to market volatility, and she paid $459 in fees. These are not isolated examples. When inbound transfers peaked last March 2025, our clients had $3 billion in transit from other institutions. Putting aside the discussion on execution costs, delays benefit the sending institution at the client's expense. During a manual transfer, the client's capital is removed from their account and placed on the sending institution's balance sheet, available to be deployed for profit as loans or to meet liquidity requirements without any corresponding benefit to the client. It's not acceptable. The federal government regulates registered accounts through the Income Tax Act.
Ms. Oliver, can I ask you to wrap up, please?
Yes, sure. We recognize there is some jurisdictional complexity, but the absence of a panacea within the purview of a single government
Thank you, Ms.
regulator.
Oliver. I'm going to have to cut it off there.
Okay, great.
We've
Thank you.
concluded the time. Okay, we're going to begin our first round of questioning. On va commencer avec Monsieur Lefebvre pour 6 minutes, s'il vous plaît.
We'll begin with Mr. Lefebvre, 6 minutes. Inaudible, without a microphone. I'd like to take advantage of the fact that the FCCQ is here today, and I'll address my questions to them. I have the recommendations you made there in front of me, and one of those, which is very current, is about the temporary foreign workers program. This weekend, I put some questions to the Minister of Finance asking whether he would support a grandfather clause, and he never actually answered. How would you envisage a grandfather clause for Quebec entrepreneurs? Thank you for the question, Mr. Lefebvre. Yes, we were in Ottawa last week with business leaders, specifically about the temporary foreign workers program. Here's how things stand at present, since permits aren't being renewed by the federal government because of the restrictions imposed a little over a year ago. Businesses, in practical terms, are having to cancel contracts and suspend investment projects because they're short of workers. These are difficult decisions being made in many sectors. We're asking the federal government at least to grandfather temporary foreign workers who are here, have jobs and are integrated. They have to be allowed to remain here because otherwise our economy would be in even more difficulty than it is already in Montreal, the hospitality sector. In other cities and other sectors, we're seeing the same problem. The only short-term solution is to keep these people in their jobs. Do you have any commitment from the government? Did you get a commitment once you explained everything? We can see that the problem is in the region. The unemployment rate is below 5.5%. So it's more critical in the regions. Did you get any commitment from the government? On this, no. The issue for us is that the federal government and the Quebec government are sending the ball into each other's courts, as it were. We're asking both of them to agree or implement measures that they themselves can control. The federal government controls the temporary foreign workers program, so they can take action. And since we're talking about financial issues at present, well, businesses were consulted, and those who are affected are losing on average $500 million and anticipate losing another $2 million on average over the next few years. So, of course, the bigger the company, the greater the financial impact. Clearly, this is a humanitarian issue, but it's also very much an economic issue. If companies are using the temporary foreign workers program, that means they can't find people where they are. It is a last resort for them. So we need to prevent workers under the program who are here from leaving. It's going to have an impact on Quebec workers in a company because, for example, if there's a shortage of electricians or welders, it's having the company in trouble is also going to affect the jobs of managers. I'll give you an example. You were talking about welders and temporary workers who've been here for a few years. They're doing great work. And these are jobs in small towns when a spouse may work at the local convenience store or in a local restaurant, and that's the kind of thing that keeps our small towns alive. And the children are part of society as well. I'm a former business person myself. I was in manufacturing. I worked in roofing products. So it's very difficult for these companies to see what to do next. Back to Ideal Cargo that I was talking about. 6 employees would lose their jobs soon if their permits of their foreign workers aren't renewed, and they've got a full order book. Last week, we had a representative with us from CF Metal, and it's the same thing. If they can no longer count on temporary foreign workers for a specific portion of their business's value chain, it'll affect the rest of the business. For example, workers are here for the Philippines. The program is important because those workers are not yet in a position to apply for permanent residency because they haven't attained the level of skill in French required by the Quebec government. So it's not possible for them to apply for residency as we're being told they can. Thank you. I'd like to talk about balancing the budget. You said it was important to come back to a balanced budget. I talked to the Minister of Finance about that as well, and he said that we were now in a different world and there was no actual deadline or calendar for coming back to a balanced budget. Brief answer, please. I'm going to answer. I'm the economic director. We want a balanced budget act in Ottawa, like the one in Quebec, so that budgetary policy is predictable over time. We know that Canada is in a relatively good position when it comes to the percentage of debt to GDP, the debt to GDP ratio, but the public debt is still very high. I'm afraid I have to stop this. Thank you, Mr. Lefebvre. Mr. Without 6 minutes. Thank you, Madam Chair. And welcome, everyone. And thank you all for being here. I have only 6 minutes, but I think I might get to a second round if we all do what we need to do. I don't know where to begin, but I'll begin with the FCCQ. Thank you for being here today, gentlemen. I do have quite a number of comments, but the goal isn't really for me to speak. It's to hear you. So, generally speaking, Mr. Lavigne, how would you describe the views of your members on the federal budget, generally speaking, in broad terms? Thank you for the question. On the whole, they take a positive view because it focuses on increasing private sector investment and defense investment. That was a priority that we had set out in our pre-budget brief. And on the whole, yes, positive view of the budget. Thank you for being brief. As for defense, well, yesterday we were to announce our defense industrial strategy, but given the events, that has been postponed. But the strategy is ready and will be announced soon, and it constitutes an important component of what we'll be doing moving forward. It'll be important for Quebec as well. Private sector investment is at the core of the budget. We want to accelerate investment. So with that in view, and I'll come back to temporary foreign workers at the end, with that in view, you briefly alluded to transfers by companies, and in Quebec and other places there will be a significant number of such transfers, and this is something that the Federation has been asking for some time. What, in your view, would be the most effective measure that the federal government could put in place to facilitate these business transfers? Thank you. Hubert Yu, Economic Director of the FCCQ. 50,000 business transfers are expected by 2030 in Quebec, so we're disappointed to see that there are insufficient incentives because the opportunity costs will be significant in spite of the increased cumulative capital gains exemption, because those who have to pay capital gains of over 1.25 million will be more numerous than expected. In Quebec, we have the 50% plus 1 Act, which obliges family business transfers to immediately transfer from the first year 50% of voting actions so that they can access the capital gains exemption. So what we've been asking for is to allow the progressive transfer of voting shares to alleviate the burden on family businesses, which are extremely important to Quebec's economy. Thank you. We'll talk about that a bit later. You suggested something that intrigued me. In our effort to double exports outside the U.S., you talked about tax incentives so that businesses could increase their non-U.S. export activities. Could you tell us more? Elaborate on that, please. Yes, it's an interesting question. The government's goal, as you know, is to double non-U.S. exports by 2035. There's a significant diversification objectives. And across the world and in the U.S., there are tax incentive models that encourage just that. For example, in the U.S., there's the foreign-derived intangible income tax, which makes it possible to de-tax part of the revenue from exports to new markets. So we believe that it would be a good idea to do something similar in Canada. Another way of going about it would be to provide grant tax credits covering part of the marketing and business development spending by new businesses, by small SMEs in international markets, So there are two potential ways that would achieve that goal. Thank you. I've taken note of that because it does look very interesting. There's a budget every year, so there'll be a budget this year. And now, temporary foreign workers. Yes, I understand the issues very well. They are complex indeed. There are two governments involved, but we are working on temporary solutions, and all I can say is that there will be announcements soon. Thank you, Mr. Leitao. Mr. Garon, 6 minutes. Thank you, Madam Chair, and good morning to our colleagues and the witnesses who are here today. My question is to the FCCQ. You said the federal government's role was important in infrastructure transfers. You take a positive view of the Strong Communities Fund. The Minister of Finance had announced $50 billion in infrastructure of development. The Strong Communities Fund is $51 billion over 10 years, so that's $5 billion across Canada per year, and $500 million for Quebec for hospital infrastructure. That doesn't even cover the Maisonneuve-Rosemont Hospital. What do you think about the federal government's role in infrastructure transfer? And yes, is what's being done sufficient? Sufficient? It'll never be really sufficient because the infrastructure needs in Quebec are tremendous. A little over a year ago, we did a study on maintaining assets. So what's lacking is not investment in new infrastructure that's coming, but it's investment on maintaining existing infrastructure. I use the Montreal Metro every day. There are an increasing number of issues. The Saint-Michel station had to close recently. We are seeing the impact of the current state of infrastructure, the impact it has on everything. So before setting out to invest in new projects, we should make sure that what we have works as it should. There is a tax capacity or budgetary capacity in Ottawa, and yet infrastructure is largely municipal and provincial. That shows how federalism doesn't function as it should. As an economist, I know that, for example, that Great Britain reviewed their budgetary systems and their tax systems periodically. Other countries do this, and this is something that should be done in all sectors. The government is choosing players and sectors and taking a position. Some sectors are left aside, like telecommunications, when we need to strengthen our fiber optic sovereignty. And we know that this will, in many cases, disadvantage smaller SMEs. If you have any changes you could make on fast-tracking of amortization, what would you do? Yes, I think that incentive needs to be extended to other sectors, particularly mining and defense, given the very significant investment that's going to be needed in the coming years. We need to catch up on private sector investment and productivity, and that will require ongoing and increasing investment. Mr. Rio, do you think it's the government's strategy to make things temporary, to tell companies, take the advantage of this while it's there? Perhaps there's also the issue of budgetary capacity, I imagine, but predictability is very important for businesses. The point isn't to say, invest now and then stop doing anything. You have to invest year after year to catch up as we need to. Mr. Rioux, you talked about the regulatory weight. The government does provide some freedom. The main restrictions that are needed, what restrictions would be needed to make sure that the will of Parliament is carried out? Well, what we need are objective criteria that have to be, I believe, more clearly defined than they are in C15. C15 is quite broad, talks about risk management, and public interest, but that doesn't really mean much in detail. So you think it should be more precise? Yes. France experimentation is a good example. It has very precise criteria and it works well. You can see what the criteria are on their website. Thank you. We might, we could look at that and use it in our amendments. Ms. Wilding, in the budget, the Minister of Finance has separated operating expenses and investment expenditure. And we're a bit unsure about things that the Minister of Finance is calling investment. In your view, is everything that the minister calls investment actually investment in the accounting sense of the word?
Thank you for the question. I'm actually really here to talk more about the tax policy than the actual accounting treatment of the federal budget. I think that's something that, you know, down the road as the budget becomes implemented and obviously the...
OK, donc je comprends. On va gagner du temps.
I understand, and I understand you're not comfortable with the question. I'll move quickly to the FCCQ.
I just don't think I'm here to opine on the accounting treatment versus the underlying tax policy.
Non, mais on est là pour parler du budget. Puis les...
Well, we are here to talk about the budget, and it seems to me accountants are well placed to tell us what an investment is. Thank you, Madam Chair.
Gahan, we will now continue with Mr. Kelly for 5 minutes, please.
No, I think
I thought you said you were switching.
in the second hour.
Oh, in the second hour. Okay, well then we're going with Mr. McLean. Thank you for 5 minutes.
Thank you, Madam. My questions of Ms. Vega and Ms. Oliver today, if I may. First of all, open banking has been far delayed in Canada for a long time. I remember working on it in 2017 and 18, and somehow it's been stalled ever since then. And that is not a good thing. Do you know why it stalled as long as it did in Canada? I'll ask Ms. Oliver.
Look, I think there, in terms of support, there's only been growing support over the last number of years.
I'm not, sorry to interrupt, but I'm not asking about support. I'm asking what took the government so long to get between 2018 and 2016 to any kind of open banking framework when every other country in the world was moving much more quickly.
Mm-hmm. I couldn't say.
Okay, thank you. Australia has real-time rails already, has had real-time rails since open banking was introduced over 8 years ago. Do you think real-time rail will be relevant once crypto trading and Bitcoin and stablecoin issuance will replace it? And is it going to be more expensive than the alternative at some point?
We absolutely see the RTR as critical and complementary to other innovations. Stable coins we think are also very important, and but digital assets are in their infancy. Every other G7 country has a real-time rail. All those countries had government leading that and mandating participation to ensure that consumers would benefit and that competition would increase. And we absolutely see a role for the RTR in Canada to do the same.
Okay, what are the costs of a real-time rail versus a stablecoin transaction?
Well, I'm not sure. I know that the vast majority, well over 95% of stablecoin transactions are in USD. Okay, but we're talking about a legislation here that's going to move and get set up in Canada, and it leads to my next question, the importance of having this infrastructure in Canada so we abide by Canadian law. Do you think that's adequately laid out in the government's framework here about how they're going to establish a crypto
stablecoin regime in Canada?
Well, I think the step to assert jurisdiction over stablecoins as a payment instrument is certainly in line with how our consumers use it. So if you were to look at Bitcoin, which we offer our clients and are regulated as a security, in a given month, 10% of the total volume that we hold. So let's just say if you had $1 million in Bitcoin, 100,000 would transact in a given month. USDC is the most common stablecoin transacted on our platform, and it moves on and off at 250%. So we see that it is being used to settle transactions, not to buy and hold. And so we are supportive of of federal jurisdiction over stablecoins, and we hope that provinces.
Thank you. If I can
Sure.
move on here, just quickly, please. The last question to you is the one about the Bank of Canada as the regulator here. And do you see a problem if there's other issuers of stablecoins, if the Bank of Canada, which is also a potential issuer of a stablecoin here, is the regulator of those entities?
I think so. We are comfortable with the Bank of Canada as a regulator of payments.
Do you think that there's an issue with privacy if the Bank of Canada, the Government of Canada, is the regulator of the stable coins? And I'm thinking about issues like we had in Canada here where the government froze bank accounts. The ability to freeze, the Bank of Canada to be able to freeze stablecoin issuances is a gross overstep, as the federal court has said. Do you think that this leads to that risk?
No, I don't see a correlation.
Okay, and I'll go to Ms. Vega now for a quick follow-up question. The issue with this act is that there is no interest payable on the stablecoins, and yet most of your issuers give bonuses and interest in order to move over. Do you see this being a problem as far as getting a stablecoin established with your members?
Sure. Well, I think that devil's in the details. Even in the U.S. and the Genius Act, just because the way that it was drafted, they also prohibit yield payment. So I think that is still early days. What matters to our members, as you rightly mentioned, is that if you're a wallet, if you're providing the service, the competitive advantage or disadvantage that a yield or a rewards scheme, if you like, will allow is what's going to determine whether or not we remain competitive as a country in the stablecoin framework. So I think that a lot of the details are still left to be seen in the regulation, but in the conversations that I've had with the folks at Department of Finance, it is well understood the dynamic and sort of the impact that this could have on competition.
Thank you, Ms. Vega. We're going to have to end this round there. Thank you, Mr. McLean. We'll continue now for 5 minutes with Mr. Sawatsky.
Thank you, Chair, and thank you to all our witnesses for coming today. Ms. Vega, I just wonder if I could maybe start with a general question. If you could just summarize what from Budget 2025 do you think will be most beneficial for Canadians?
Quite frankly, I think that big picture, this spirit of competition in some of these reforms for the financial sector is something that I mentioned in my remarks is long overdue, and it's something that you can see the impact across the economy more broadly from a consumer perspective, but also from a small business perspective. Open banking, I think everybody in this room and some of the members have already mentioned it themselves. A lot of us have been waiting for this for a long time. And I think that it's time to move to implementation, execution, and making sure that it works in the way that it's meant to work in a pro-competition spirit. Once we have that, you will see impacts in the reduction of friction to financial transactions. You will see an impact in participants having to show up and offer better offerings, and different participants being able to offer more beneficial loans and services to their consumers. And I would say specifically, I would point to small businesses, because right now transacting as a small business is very, very complicated. I am convinced personally that it prevents small businesses from entering global trade. You know, if you're a small business and you're facing a payment that's going to be delayed for several weeks, you think twice before you even enter those transactions. So I think that both Open Banking and Stablecoin Act, from our perspective, are the ones that are going to be most impactful.
Thank you very much. So I guess you would say that it's on the right track, this budget. Is that correct? Certainly,
and I would encourage the members to approve it. I think from our perspective, It's a robust package of reforms for the financial sector, and if there's any gaps to be addressed, we are very committed to working with the government on regulatory developments. So I'm happy to talk more about that.
Thank you very much. That's wonderful to hear. I certainly hope it passes soon as well. Over to you, Ms. Oliver. In Wealthsimple's pre-budget consultations, there was a note here that exit fees have risen from $0 to $75 in the early 2010s, near ubiquitous $150 per account in 2025, costing Canadians hundreds of millions of dollars annually and borne disproportionately by Gen Z and millennials. So I was just wondering if you could speak broadly on the exit fees.
Sure. Yeah, the disproportionate impact on young people, which I think is very important because we talk a lot about reductions in trust and confidence in government and in large institutions. And I think it's important to think about what contributes to that. And if you have $5,000 in a first-time home savings account, and you are moving, or you're getting married, or for whatever reason you've decided you would like to move that account, when you are being levied a $150 fee on a $5,000 balance, it feels defeating. It feels like large institutions are able to take advantage of you and get you coming and going with impunity. And they feel that way because that is what they are living. That is what they are experiencing. And the people who are able to have these fees reversed or reimbursed are wealthy clients. The vast majority, we try to reimburse. We used to reimburse fees that other institutions charged. We do not charge exit fees. We used to reimburse fees for clients with accounts above $5,000. It was not sustainable. We increased it to $15,000. It was not sustainable. We increased it to $25,000, but we made it automatic instead of having people have to request it. And we realized that only 35% of clients that were eligible for reimbursement were asking. We looked into who had not been asking, or the reverse. The wealthier you were, the older you were, the more likely you were to ask for the reimbursement that you were entitled to. And forget that half the clients transferring to Wealthsimple were not above the $25,000 threshold. According to CRA, the average TFSA does not reach $25,000 until the age of 50, which means the average client under 50 moving a TFSA is not eligible for reimbursement. And even if they are unlikely to know to ask.
Thank you, especially at a time where a lot of young people are having issues with affordability. I think there would be some welcome change there. So Wealthsimple's pre-budget consultation also called for completing consumer-driven banking.
Apologies, Mr. Sawatsky, that completes your time. Thank you very much. On va continuer avec Monsieur Garon pour 2 minutes et demie.
Mr. Garon, 2.5 minutes. Thank you, Madam Chair. I'll continue with the FCCQ. I wanted to talk about the digital services tax. We applauded the tax, even though it might have been imperfect. The Liberal government decided to repeal it to please Donald Trump, but nothing pleases Donald Trump, so it led to nothing. What do you think about the repeal of the digital services tax? And more generally, what do you think about what's happening with our media, all media that are supposed to be the spine, the cornerstone of our democracy? Could we have used revenue from the digital services tax to establish a fund dedicated to support local media? What's your general view? Yes, I think eliminating the tax is a mixed opportunity because it would have helped our telecommunications industry, which would then not, because that industry wouldn't have had to pay it. As my colleague said, many local and regional media in Quebec have shut down over the past 20 years, and we believe that to compensate the elimination of the DST, measures can be put in place. For example, extend the scope of the reimbursable tax credit for the cost of journalistic work that would cover written and broadcast media, spend more on government advertising in Canadian media and amend Section 19 of the Income Tax Act to prevent the tax deduction for advertising in Canada by foreign platforms. Sorry, it's not much time when you're the second opposition party. Do you see untaxed platforms that are getting a free ride and making money with material produced by local media? Aren't you frustrated by that? Well, I'll put it this way, Mr. Garon. The competitive playing field needs to be level for everyone. I'd like to add something. Current legislation and the CRTC dates from a time where the big players were Canadian. Now the big players are international corporation, and even our largest Canadian and Quebec businesses are not the major players they were in the past, not in today's landscape. Thank you, Mr. Garon.
Bobina for 5 minutes, please.
And I will be directing my questions to Ms. Wilding. Thank you for sharing your time. I used to be an adjudicator in the mid-market space and the commercial space, and so naturally accountants were my best friends for many years. So thank you for sharing your expertise with us. Just generally speaking, where do you see the biggest compliance cost for SMEs?
Well, I think from a small medium market perspective, actually one of the biggest hurdles is the corporate tax, right, which is a disincentive to growth. And small businesses hit that threshold of 500,000 pretty quickly. So we're actually disincenting small businesses to grow at a time when, critically we need to be seeding them. That truly is the largest impediment from a small business perspective in terms of their ability to grow. Once you hit that threshold, you are significantly increasing your tax, as well as it's just disincenting them to invest. And we see that in the conversations that we have with our practitioners who are tax advisors to the small medium market space, which is obviously a very big component of Canada's economy.
Exactly. And I always say it's the small businesses that become medium businesses that become large businesses. So of
exactly.
course, we want to make sure that we are supporting the small businesses. So on that light, are there any federal tax rules that disproportionately hurt startups or that small business, that family business perhaps, from your perspective?
Well, I go back to some of the comments I made at the beginning, which is, we really are moving we're already there, although our tax system has not kept up, into an innovation and intangibles, a digital economy. Yet we're trying to operate in a modern economy with a tax system that is 60 years old. So the tax system doesn't really reflect or understand things like the movement of IP. Take, for example, a patent box regime, which was in the fall economic statement. So curious that it didn't find its way into this, hopeful that it will, because those are some of the examples of bold tax reform that we need. We need broad-based tax reform, both at the corporate and the personal level, if we are going to incent small businesses and entrepreneurs, particularly in the innovation economy, to step in, to invest, and more importantly, to stay in Canada, because things like IP and intangible assets, they move very easily across borders.
Yeah, you're right. And so I recall from my times in lending that cash flow was a big piece beyond any other metric. And oftentimes cash flow in uncertain times is the most critical, the most important aspect of the business for a small business. And right now, you could say we are in those uncertain times economically. What legislative changes would you recommend that we consider to improve the stability of that cash flow, particularly for SMEs?
Yes, cash flow is critical, right? If you're trying to make your payroll and quite literally some of the small businesses are in terms of their ability to go payroll to payroll. I think some of the things that, are in there in terms of the write-offs, the ability to have some of those accelerated write-offs does help. in the short term. But the bigger piece is the uncertainty of some of these that are going to potentially encourage investment and therefore help cash flow, but are not actually permanent, right? So they will hold back from additional capital investment, which will inhibit in terms of cash flow just follows in terms of where the actual capital will flow as well. So I would say I would bring it back up to where the policies are that incent, the permanency of the ability to actually invest and see that over time. Which back to the super productivity is fine, but it's a very short term, and there are many other things that need to be done there, along with the shred. Shred would be another example of that.
Thank you for that. And I do recall having a number of conversations with business owners who sometimes were found it inconvenient and an administrative burden to have the volume of reporting that they in compliance. It forces them to allocate resources to that. Do you have any recommendations for us to alleviate that burden?
Very briefly, please.
Yeah, well, I'll say the first thing is it's startling. It's over $4 billion a year in a recent research report, which is 0.15% of GDP in terms of the actual cost of compliance and administrative burden.
Apologies, Ms. Golding. I'm going to have to end it there. That concludes the time for this round.
Thank you.
Thank you, Ms. Kobina. We'll continue now with Mr. McDonald for 5 minutes. Thank you.
Good morning, Madam Chair, and good morning to all the witnesses attending this morning. I'll ask my first question to Ms. Vega. Ms. Vega, the Bill C-15 has the consumer-driven banking provisions and the development of the real-time rail. It's obviously intended to modernize our banking system in Canada, maybe long overdue. But on the other side of that, many senior rural Canadians rely on that face-to-face meeting with their banking institution. Can you speak to how we get the best of both worlds? So that do we need education? Who has to provide it? Like, the seniors are the most vulnerable to banking charges because of the nature of them doing transfers upon retirement and then more transfers upon death. So is there a way that we can get the best of both worlds?
Financial technology, as you know, is digital first. So I think when it comes to
Your mic is not.
Is it working? Yeah. Okay. Thank you. Financial technology companies are digital first. Many of them don't really have brick and mortar presence like a traditional bank, for example. But disruption is affecting everybody. The banks sometimes are closing branches, et cetera. And I think that you raise a good point that seniors and rural communities are perhaps more vulnerable. There's a big education piece that I think needs to happen, both on the government side, but also industry. And when you raise things like the RTR, for example, I really think that it's important for us to think about it as an ecosystem, right? No single thing or no single technology is operating in a silo, and no single market participant is operating in a silo. So we see it even on the regulatory side, right? So if you're developing regulations for open banking or for stablecoins, a lot of this is dependent on whether or not we have a system that allows for that real-time movement of money, right? All these things are stacked. It's not separate things. And I would equally consider the risk equation as part of that shared responsibility for the entire ecosystem. So from our perspective, we have been very much pro-regulation. We have been an advocacy voice in favor of regulation, and one of the reasons why we supported the RPAA so strongly, because we believe that trust underpins our sector, and it's important for the customers to be protected and not be held liable when things go wrong. So, and that applies to all customers across Canada. So I would say, to your point, does this require more education, more collaboration? Absolutely. And I think I personally have taken that on to make sure that we are reaching across the aisle to the different participants to make sure that we're all in it together to protect the Canadian customer.
There we go. Maybe next I'll go to Ms. Oliver. Ms. Oliver, I'm very encouraged by you spoke about the fees and your goal with Wealthsimple to reduce banking fees. I run a business for over 40 years before I came to Parliament Hill, and banking fees annoyed me very much during running a business, especially simple things that you addressed in your opening remarks. So I just wonder if you could give me your opinion on just the presence of more options. We all hear competition is good. Is that going to make, and I won't name anyone, but the big five more responsible in their fee charging?
Well, I'll start. I think I see a real parallel to your comment about running a business and how things add up. Everything adds up. And also to touch on your comment about seniors and in person. There are people who are much more comfortable in person, and there are people who have mobility challenges who are grateful to be able to manage things remotely. Technology also brings security options. My mom loves being able to go into her Wealthsimple app and lock her credit card. It cannot be used because she can turn it on and off on her app. And lots of institutions have those features. And so long as there is a market demand, the market is well positioned to fill it. And so whether that is in-person service for people that prefer it, we have a group retirement savings plan that we initially launched to serve our own business. You saw last week CD Howe say that only 19% of small and medium-sized businesses offer workplace retirement savings plan, and that's a concern. Well,
Ms. Oliver, can you wrap up quickly, please?
Yes. We now serve 1,000 small and medium-sized businesses with retirement savings plans for their employees, $1 billion that their employees have saved. 95% of them
Oliver.
did not offer those plans.
End it there. Thank you very much, Mr. McDonald. That concludes the first hour of our meeting today. On behalf of the committee, I would like to thank all of our witnesses, both those in person and online. We will now briefly suspend as we change over for the next part of our meeting. Thank you very much.